TSMC has generated strong Q1 2025 earnings results as I correctly forecasted on my last initiation pitch. Thus, I'm still recommending long TSMC. Trading at a 9 times forward free cash flow multiple, which represents 24% below the historical 5-year average, the stock offers a compelling opportunity to capture 25% upside for long-term investors at a 2.5 times risk-reward ratio. As I accurately dismissed the Intel JV potential and alluded to TSMC's strong pricing power, the company isn't pursuing any JV tech licensing and is considering raising prices for 4nm chip production at its US facility by as much as 30%. Although I was also right about predicting tariffs on semiconductors, I was wrong about assuming that the duration of tariff uncertainties would be short-lived. I now think that it could be long, even with Scott Benson's now expecting de-escalation in the US-China tariff fight. My first new thesis is the following. While the street interpreted hyperscalers delaying several new data center leases as cutting AI spending, I'm arguing that they could have pulled away for other non-demand related reasons. After I posted my write-up on Substack, news broke out that confirmed my thesis. Kevin Miller, VP of Global Data Centers at AWS, wrote, "This is routine capacity management, and there haven't been any recent fundamental changes in our expansion plans." My second thesis is that doubting the sustainability of TSMC's AI orders based on its customers' premature data is wrong. NVIDIA's bears cite a 1% decline in Microsoft's return on invested capital from 2023 to 2024 and low return on assets of CoreWeave and Navius as evidence of poor AI spending returns to make a case that cloud providers will decelerate their AI capex. However, return on invested capital is a lagging indicator, and you can't formulate a structural trend analysis based on one-year data, especially when the returns of AI capex show up in the later stages of investment. Moreover, CoreWeave and Navius are growth companies that are expected to show low ROI in the early stages of their life cycle due to their heavy upfront spending business models. My third thesis is that incremental gains from the Intel outsourcing model would far exceed any share loss to Intel Foundry in the next 5 years. The underappreciated risk is that the stock will fall dramatically if TSMC or hyperscalers were to cut their 2025 capex guidance. Should any one of these events occur, this will be my signals to sell TSMC.